In today's episode, we speak with my friend Dr. Ori Hampel. We discuss building the correct foundation with the infinite banking concept, building, creating, and leaving a legacy for more than one generation. And then he also shares with us some pretty cool insights about free market medicine. I'm excited to have him, and I hope you enjoy listening. Thank you. Welcome to the Banking with Live podcast. My name is James Neathery. I'm your host. And my friend Ori Hampel is with us today, and it's kind of unscheduled. I mean, we didn't know we would have this opportunity really until late last night, and so I'm as pleased as I can be to have you here to take the time to come here and sit down with us, Ori. Really, the background here is, we became acquainted last year, right? You're a physician in Houston, very familiar with life insurance and the status quo of financial advice. It's my firm belief that physicians, any high income earner, especially physicians and dentists, I have found that they almost have a target on their back from the financial industry. Now, I could be wrong.
No, you're correct.
And, y'all are, from my perspective, y'all are very busy doing what you do. And you, in the collective as a whole, you rely on experts in the areas that are important so you can focus on your practice. And sometimes those experts may not have your best interest at heart.
That's been my experience. I've had good experiences with experts, and I've had bad experiences with experts. And I think, obviously, the most important lessons have been the negative ones. But those lessons have also reaffirmed the positive ones.
Right. I'm very interested in some of the lessons you have learned, right? Can you share those with us?
Sure. As a physician, there are several things that are very important to me. One is protection of assets, and so life insurance products are almost bulletproof against any sort of liability and lawsuits. And the other thing is that you want to build wealth, or if not even wealth, just build an avenue of retirement. And the various, quote, qualified, unquote, plans have limitations on how much money you can save. And they've got very obvious other negative aspects. So I remember one of my first forays into listening to life insurance agents, etc., was that I did have a initial term life policy to protect my family, and I think that's a given that somebody should do. But then I was trying to protect some assets, some cash, and I purchased an annuity. Mm-hmm. And it was a long commitment of 15 years until the penalty phased out, and then I can withdraw the money without penalty. The problem with that annuity is that the return was extremely blunted, and it was really the wrong product for somebody who was young and in their 30s to be involved with. That's more of a product for, I believe, a different age group. And so that was a mistake, and I learned from that. And
well, what'd you learn besides a long surrender charge in your 30s? Woo.
I learned that had I put that money into whole life insurance, more specifically whole life insurance with a mutual company that's dividend paying, I would have been so far ahead. I mean, ridiculously far ahead.
How long did it take you to learn that lesson? Because we're going back in time, the time you purchased the annuity, then we're going forward, right? And you discover or come to the realization that that might not have been the best thing for you to do with your money, although it's bulletproof in Texas when it comes to asset protection.
Right.
But the returns are blunted. And how old are you? About 40 at that time, or?
No, I was in my mid-30s, and what I learned many things, but what happened was it took me a long time to learn it because I didn't know what I didn't know.
Right.
And at that point in time, I looked to protect my assets. One with an annuity, and number two was with a variable universal life insurance policy.
So you discovered that the annuity might not have been the best fit.
Correct.
So then you were looking for something else, or an advisor or an agent said, "Oh, well, this."
No, I the reality of medicine is that I went into practice in 1998, and the most money I ever made was in the year 2000, as far as taking home money. Mm-hmm. And every year since then, I have been more efficient. I see more patients. I do more surgeries. I collect less money, mm-hmm. and my overhead rises. And what I take home from my family is that differential in between. Mm-hmm. And that has been shrinking every year consistently, in some years shrinking more than other years, but it's always a downtrend from the year 2000 till today. And so I made certain plans, but my plans proved that I was making plans on what I was earning, except my earnings were decreasing. So that was one problem. But I found out other things, is that you really have to have an agent and an insurance company that are responsible to do their job as far as educating you as a client to know what you're getting in, to really make you understand whether it's appropriate for you, and to make sure that there's no errors. For example, that variable universal life insurance policy was growing. I was investing it well. And a number of years later, probably about 4 or 5 years later, I hooked up with a new insurance agent. I was always looking for financial planning advice and whatever. And he asked me to review my existing policies. And I said, sure. And I gave him permission to do that. And then we got together, and he explained to me that my variable universal life insurance was a MEC. And my response was, what the heck is a MEC?
What's a MEC?
And he explained to me it was a modified endowment contract. And I said, that's great, but I didn't learn about that in medical school. What does that mean? And he explained to me, well, all the favorable aspects of a life insurance policy were negated by the MEC, and so now it is taxed and treated like an annuity. And I said, okay, so why is that bad? He said, well, any money you take out of that MEC before age 59 and a half, you pay an additional 10% penalty. And I said, that doesn't sound real good. And he goes, and any money you borrow from your policy or anything you cash out, you pay an additional 10% penalty on. And he explained to me, and you become LIFO versus FIFO. And I said, I'm like, I don't want
I'm a physician. I'm not an accountant.
I mean, I know lots of acronyms and initialisms, but I don't know that one. He goes, it means it's last in, first out, not first in, first out. So any money you withdraw, you're withdrawing your profits first, which get taxed in addition to the 10% penalty if you're under 59.5 as ordinary income.
Oh, and you're a physician, already earning a high income.
So I'm already in a relatively high tax bracket, which means that Uncle Sam gets to share in that a lot. And so, and then whereas had it been life insurance and not a MEC, then it would be first in, first out, FIFO, which means the initial money you put in is already post-tax, so you don't pay tax on that. So all the positive aspects of that life insurance plan were negated, except for the creditor protection and the death benefit.
And the death, right.
And then he explained to me that I should have been informed of this. And what happened was the agent that sold me the life insurance policy no longer represented the company. And so the company became my de facto agent. And they were not good fiduciaries. But I didn't know any of this. So by the time this other agent educated me about my errors that I didn't know I was making at the time,
right,
it was beyond 2 years, and an attorney told me I couldn't sue the company for being irresponsible and unethical, and whichever way, what other words you can describe them. And so there was nothing I could do except either pay the penalty upon withdrawing funds. I could move it and create another MEC policy. There were all these kind of other things I could do. But I had quite a bit of money that was suddenly unfavorable money, and money that was not going to do what I wanted to do as far as providing me, avenues of having money available for retirement the way that it could.
Right.
And so those were very important mistakes, which led me, so with that agent, he explained to me several things. One, he explained to me something I already knew, which was that at the time I didn't have enough life insurance. And so, but then he recommended that I get a dividend-paying whole life insurance policy. And it was with a mutual company. And what happened was, it was right around the time that and so I did. I bought a policy. I actually bought two policies, and they were a little different. One was a universal policy, which I wouldn't do again, and the other one because it has too much risk, because it has market risk, and there's no reason to do that. And the other one was a whole life policy, and I was content for a while. And I'd also explained to him that I really wanted to use this as a retirement vehicle. So what he recommended was that I would maximally contribute to my life insurance policy. And so what I learned was that most people, when they get life insurance, put the minimum amount of money to maintain the policy.
The death benefit.
To maintain the death benefit. And maybe save a little bit. Maybe put in a cushion there for in case it doesn't perform as well. Whereas what we were doing was using the life insurance as a vehicle for life insurance, but maximally contributing every year to the MEC limit so that it doesn't become a MEC. And he said that he and his company are very good about monitoring every single year. And of course, since I learned my lesson, every year I make a phone call to make sure we're staying below the MEC limit. And even though I trust them, I still double check. I've been burned big time. So I've been maximally contributing. So what happened was that a number of years later, I bumped into you at a Texas Medical Association meeting. And I bumped into a physician who was using life insurance plans, and he was retired from practicing medicine and whatever. And you gave me a little softcover book, Bank on Your Life.
Becoming Your Own Banker,
right.
Or Nelson Nash,
right.
Yep.
And I read that book. That's a one evening read.
Right.
And, even for somebody encumbered by significant amount of education, it still only is a one evening read. And I
appreciate your comments, sir.
And it really opened my eyes. So interestingly, I took that book. I didn't take the book. I took the lesson I learned from the book, and I talked to my insurance agent. I said, well, can I do this with those policies that I have? And he said, you can with the whole life one. You might do some of that kind of stuff with the universal, but the whole life one, you really can. I said, well, I need doing the math. I'm not saving enough money for retirement, and at the time, and I knew that, and that worried me because at some point I do hope to retire. And so I want to be able to afford that. And so I got more life insurance policies. And we got life insurance policies on my wife and on my 4 children. Each of my 4 children owns their own life insurance policy. So we would gift the children money as saving, and that's something that my parents taught me.
Sure.
My parents saved college money for us by gifting us money and staying below the estate gift tax exemption limits, which has changed with time.
Sure.
And so we had our own bank account, our own custodial bank accounts that my parents controlled and eventually were handed to my siblings and to me when we were adults. And so I did the same for my children. I created custodial accounts for them and passed on some money to them. And that was, so for my first 2 children, our college plan for them, we initially had a college plan for them, a 529 plan. Mm-hmm. But then as soon as I learned the stuff about these life insurance policies and I saw their power, and I didn't just see their power because I read the book.
Right.
I saw the power because I already had a policy that was performing amazingly and better than the initial illustrations. And all I did was make a payment once a year. I had nothing to maintain. I had nothing to look at.
No management, a phone call. Is this a MEC? What is a MEC limit?
I didn't even have to make the phone call, even though I did. So I literally, all I had to do was write a check once a year and make sure that I save money, because you have to have discipline to save money. That's an important piece. So each one of for our younger 2 children, we didn't do a 529 plan. We just did life insurance plans for them. And it's their life insurance plan with their money. Mm-hmm. So when they're adults, they will have that as an asset. They actually have it as an asset now. And 2 of our children are adults, and they have that asset. And so what has happened then is we hooked up, you and I hooked up because I realized that I needed to save even more money for retirement. And we got additional policies with you for me and for our 4 children. And there's 2 aspects to this. One aspect is it forces us to save, because our first priority is to make sure we save money and deposit it into the life insurance policies so they can grow and they can perform, and we have that money for retirement. So that is our first priority, is it forces us to save.
And is the way you're saying that, that's not a bad thing, is it?
No. Being
forced to save, accumulate capital.
Right. So before you spend money, before you take a trip, before you buy a car, if you have one that works and you don't need a new car, you think twice about it and say, you know what, let me throw the money into my life insurance policy. And then the second aspect of it was that by putting the money into a life insurance policy, I still have access to the money.
What? And you're not 59 and a half?
And I'm not 59 and a half, and I'm not retired. And I have access to that money tax-free, not tax-deferred. And that is huge. And we have used that. So we've used borrowing from our life insurance plans to make purchases. And then we pay the life insurance company back. So instead of using a bank to do banking, we have used our own bank, our own life insurance policies, to do banking. And whenever I wanted to do that, I didn't have to fill out a loan application. I didn't have to sign 50 times like when you refinance a home or purchase a home. Mm-hmm. I made one phone call, and the next day, the money was an ACH transfer into the bank account, the regular bank account. And then I used the money. And then I would pay back that loan.
Discipline.
And it is just absolutely amazing how these policies have performed with essentially no risk, to the point where this last year, what I did was I asked my life insurance agents to run pro formas on the various policies that we have. And I have policies with multiple insurance companies and with multiple agents. Diversification. And I literally asked them, run, if I start withdrawing money as loans and not pay them back, how much money can I start withdrawing on a regular basis at age 60, 65, 70? Give me those models. And then I know what, if I want X number of dollars per year to live on in retirement, it exactly tells me when I can retire and how much more money I have to accumulate in order to retire. And the beautiful thing about this is that none of this is reported because this is a private contract. The FDIC and the federal government doesn't know what I have, because they don't care.
Unless you told them.
and the reason they don't care is because they care about only what they can seize and tax. And since it's a private contract in a non-taxable environment, the federal government doesn't care about me. It cares about me, but it doesn't care about that aspect of me.
No, they
and my
still
family.
want you producing because they still want their share of your production.
Right, they're doing well.
Yeah.
But those aspects of it were tremendous. Now, so when I look at this, and on so many levels, this is amazing. And the reason, especially with what I did with our children, what my wife and I did with our children is we created them a growing asset. That when now the two are adults and two will be adults, God willing, someday, just not too soon.
Right.
Time's
ticking fast.
Then they will literally enter adulthood with an asset, with their own mini bank. And they can use that money, they can borrow that money for their education, to purchase a car, down payment on a house, anything. Finance the house instead of using a bank. Depends how much money there is in there and how expensive their real estate is. And they will literally start life with a nest egg. And that tool is just so powerful.
What's that worth as a father?
Well, I mean, I think we're supposed to take care of our children's children. And
a good man. You're a good man.
And we don't have grandchildren yet. It's not time yet. But when we do, the death benefit of my children will go to their children. And so this nest egg that I started, that my wife and I started for our kids, will actually benefit the following generation. The other thing that this does is, especially if you look at today's society where we're not taught to save, and is that my children know, my older children know, and the younger children will know, that their first priority when they go out into the working world is they need to first fund their life insurance policy, and then they can budget everything else out. So that they're saving and they're accumulating assets and protection throughout their entire working lifetime. I think it's a mistake that we start doing retirement planning when people turn 50.
Mm-hmm.
I think we need to start doing retirement planning when people are children, because this sets up goals and parameters of financial goals to accomplish throughout your life. So, I think, and it's important that I didn't get together with an insurance agent. My wife and I didn't just set this up for our children and then just kind of manage it for them. It's important that we actually educated our older children about, this is the asset that you have, and this is the responsibility that you have about contributing to it and about saving. And so you're not doing this for us. This is already for you. This is good for you, for your future family. This is what you're doing this for. And this gives you choices in life. And it's all about being in a position to make choices.
I appreciate you sharing that. That couldn't have been scripted any better from my position. But you covered an awful lot. When you 1999 or 1998, when you were earning the high income, right, and you're buying the annuity, that was really the beginning of a lesson that you didn't see at that time. You had to look back and say, oh, I learned that lesson. Then you moved into the MEC. You had the education of a MEC through experience, right? And then universal life, right, and whole life at the same time, right? And so by the time we met, we're looking back, and you were already paying substantial. I mean, you understood life insurance, not being educated by the financial world or an individual. I mean, it was literally through your experience. You paid for your education.
And one very good agent that explained it to me.
Yes, no question.
And the book that you gave me.
So by the time we met, you already knew, you were already doing it. You already knew to avoid the MEC, the annuities, FIFO and LIFO, and the taxation and the access to the capital, how important that is. And it's important to all of us. But by you putting your money into these vehicles and then discovering what is better and what may be more beneficial to you than other things, we meet. And I'm just saying, by the time we met, right, and we got into deeper conversations, you were already, in my opinion, ahead of the curve, much from your experience and from your reading and your research, or whatever you did to learn more about this infinite banking concept. And might I ask, what did you do? What did you do to learn more about this infinite banking concept, specifically as Nelson kind of teaches it? Does that make sense? My question makes sense. What did you reach out to YouTube? You reading books and talking to your agents that you knew?
Yeah, well, I read that paperback book in an evening, and the thing is, as soon as I started reading it, picking it up, the light bulb started going off, and I was like, where has this been? Mm-hmm. And then when I realized I was sort of already maximally funding life insurance policies,
thanks to that one good agent.
That one agent, that was good. That's still good, and he's still my agent.
Yeah, absolutely.
And then I of course reached out to YouTube, and I watched YouTube videos. I've seen you on YouTube many times. I've seen others on YouTube. Listened to podcasts from a variety of people. And some people, I could tell from their YouTube presentation that maybe it wasn't a match. Maybe I wouldn't trust them so much. I've been on your email list for years. And
we don't beat you up with that, dude.
And you've never bugged me. And I'm the one that reached out to you after a while. I'm the one that reached out to you. I called you. And And the funny thing is that I have, I regret the annuity that I did. I didn't lose money,
Right.
but I regret the annuity because I could have done better with with whole life insurance, dividend paying from a mutual life insurance company. I regret the universal life insurance that became a MEC. I regret the other universal life insurance that didn't become a MEC that I eventually converted to a whole life insurance policy later because I missed out on performance because I had some market losses. And then but that wasn't my biggest regret. My biggest regret is I didn't listen to a life insurance agent that told me to buy a whole life insurance policy. And that was really my hang-up. And it was my hang-up because I didn't know what I didn't know. Mm-hmm. But his personality didn't match mine because he was very pushy. And he didn't explain to me what he was doing. He threw down illustrations from his own life insurance policies that he's using for his own financial planning and explained to me why I needed to buy a $5 million policy with a death benefit of $5 million. And at the time in my life, I was in my early 30s, and I was looking at the premium payments, and I didn't have that kind of money at the time. And of course, my income went down since then. But I didn't have the kind of money that he was telling me I had to put away.
Right.
And I didn't know this. I didn't understand that this was scalable. That I didn't have to go $5 million. I could have done a $1 million policy. And I didn't understand maximally funding insurance. He didn't explain that to me. He didn't explain any of these concepts to me. He just told me this is what I needed to do. Mm-hmm. And I don't do well with pushy agents. And you're the other extreme of that. Because I had to call you. But I don't do well with pushy agents, with people that are pushing me to do things.
Neither do I.
But I need to be explained. I'd like to think that, I can understand things, but all of us need to have concepts explained to us in a way that we can understand, from a person we can understand, that touches the nerves that we need touched for us to open our eyes and open our light bulbs. And my regret is that this guy was trying to sell me a life insurance policy in 2001, before I got the annuity, before I got the variable universal life insurance policy that became a MEC, before I got the other variable policy. I literally lost over a decade of compounding. So in other words, had I listened to him and gotten a policy in 2001, had I then later, when I had additional money, instead of putting it in the annuity and in the variable universal, if I would have opened new additional policies or bank into this policy, I would be, those policies right now, 17, 18 years later,
wow,
would be in an exponential phase of accumulation. And I would be potentially retiring, or at least having the option to retire, or slow down, or change what I do or how I do it.
Yeah.
So I would be in a completely different financial position had I listened to him, but he wasn't the right person to give me that message because our personalities didn't match, and he didn't know, or wasn't, maybe he did, but he didn't do it effectively, explain to me what I didn't know and what I could have known. And so this is kind of the lesson, is that I lost the most precious thing, which is time. Mm-hmm. I lost money because I would have done better than those other things, those other products that were the incorrect products for me. But I would have gotten into this whole life insurance with mutual company that's dividend paying, which is what he was representing, in my early 30s. And I mean, literally, I lost nearly 20 years of time, and that's irreplaceable. Mm-hmm. And the other thing about these whole life insurance in general is the premiums to maintain the death benefit relate on how healthy and young you are when you get your policy. So my children, who thank God are healthy and are young, their cost of insurance is extremely low. So their policies perform better than my policies where I'm older and my cost of insurance is higher. So this is what's so exciting to me about the policies that my children own, is the negative lesson that I learned without even knowing that I learned about my missing out on 18, 19 years of accumulation. Because those policies would have been underwritten with me being 20 years younger.
Right.
With a lower cost of insurance.
All right.
And more time to exponentially accumulate.
Right. I agree, and I appreciate you sharing that. And I don't want to jump over to the, whenever we discover this idea, this ability, it's from that point on, we're playing catch up. No matter who you are, at whatever age you're at, we're always playing catch up because of all the mistakes that we've made in the past for whatever reason, right? But you've done several things here in this short conversation. You mentioned your children and how those are structured, right? You're laying the foundation with you and your wife, continuing the foundation with your children, right? And now we're talking about a generational wealth transfer without Uncle Guido looking over our back. And God bless the legal industry. We don't necessarily have to create an estate plan every 4 or 5 years. Okay, I'm not saying that you don't need one, and I'm not saying that this negates the need for legal advice at all. But then the policies owned by your children that you have set up based on your knowledge and your experience, I mean, they're ultimately you and your wife's beneficiaries. So you carry substantial death benefits. You cannot buy life insurance without a death benefit. We're all going to graduate. That net death benefit is going to accrue to your children. They're going to have a place to put it, right? And the beneficiaries by that time on those policies that are owned and on the children, the day after you graduate, or shortly thereafter, the children are going to change beneficiaries, right, to their children, the third generation. So not only do we all have to play catch up, you're doing a good job playing catch up, okay, by expanding the foundation on what you've done. Good job. I'm just saying, good job. And when we I think it was last year when we had longer, more in-depth, more precise conversations on your experience and what you wanted to do, what you're doing, what you're trying to do. You were really ahead of the curve, in my opinion. I'm not placating you at all. Because you're here, right? And I appreciate that. I'm just saying that from your experience and your due diligence with your efforts and including your discipline, maybe modeled by your parents, and then your profession, you're doing a good job, is my point, by doing what you have done. There are very few people. I've been a licensed life insurance agent for 28 years. And there's financial underwriting as well as health underwriting when you apply for and try to obtain life insurance. The financial underwriting is limited by your age and your income. Okay. And so there is no such thing in the in the real world of being overinsured. You know, we've all heard these things that I'm worth more dead than alive, etc. There's a limit of how much death benefit any one individual can have, and it's limited by their age and their income or their assets. Very few people are fully insured with permanent whole life insurance. You're as close to fully insured as anyone I've ever met, so you've done a good job. And then you're extending that foundation to the next generation, which by design has set the foundation for the third generation. That's pretty powerful. So no question, you've got to continue to play catch up. Everyone else does too, but you're leading the way for your family. Good job.
Thank you.
Okay. Did we miss anything, Mr. Griggs? I'm going to have to clip that one little part out, this question. Is there anything else you'd like to say? Because go ahead. Is there anything else you'd like to add to that, Ori?
I'm just thankful that I learned these lessons. Of course, I regret I had to learn some of these lessons the hard way. Mm-hmm. You know, we're all imperfect, and I think, you know, a smart person learns from their own experience. Somebody who's wise learns from somebody else's experience. I would have preferred to be a little wiser here than smarter. But the important thing is that I learned these lessons and I'm applying them. And it's an ongoing thing. I'm not done. Even this last year, I learned that these policies are not quite ever fully funded. And I didn't know that. I mean, I've been doing this various life insurance product purchasing for 21 years, okay? And knowing all this stuff that I thought I knew. So last year, I finished paying off my first whole life insurance policy. So I asked the question, I don't know what made me ask it, from my agent, and I asked him, I really can't put anything else into that policy? Because then it's a mech. I mean, I can't put any more in it? And he said, let me run the model. And he did. And I can. And it's not a lot. It's just a little bit of money. But I'd rather that money was growing that policy that is now in an exponential accumulation phase, because it's a 10-year-old policy. And so that was exciting. And I said, well, why don't you run the models on all the other policies too? And when they're fully paid off, there's additional premium that they could accept and stay below the MEC limit. Because I didn't realize this at the time, and this is what I learned just this last year, is that you got to rerun these models from year to year. You got to rerun these performas because the numbers change, and the computers at the insurance company might allow you to put in more money to stay below that MEC limit to make the product that you think is good even better. And so, I mean, I think the real lesson here is, one, to have the discipline of saving, which I learned from my parents, and my wife learned from her parents. Number two is to constantly watch your assets and review them and rerun them, because they're dynamic. Nothing is fixed. Everything is dynamic, and there's moving pieces. And so you have to you don't have to do this monthly. Right. Once a year. Just once a year, just rerun models. Ask the question, are we doing everything? Are we maximizing everything? And see if you need to make any adjustments. And just be flexible to make those adjustments.
It's very easy when we look at a life insurance illustration to view that as fixed, and they are not. But another thing you mentioned earlier too is about retirement and retirement income, and running these in-force illustrations in various ways that I encourage my clients to think in thirds an awful lot of the time. If we take a whole life insurance illustration and just divide it up over thirds, you'll see an exponential curve within there. And I encourage in the first section, the first third of a policy, the focus should be paying premium. Get as much premium in as you possibly can. And then the second third, and I'm segregating these out by thirds, right, as for ease of illustration. The second third, you should master that asset and the banking function as it relates to you and your personal economy. So you should know how to run a loan or request a loan and make a loan repayment. But then the last third, that passive income in retirement, right? The collateralizing the cash value, tax-free income in the form of a loan. That's exactly how you manage that asset in the latter years of a policy. You manage that outstanding loan by running in-force illustrations. Can you take a greater loan this year? Or do you have to make take a lesser loan or what have you? But I don't want to jump over that. You mentioned that just in conversation, but you're already looking, right, at retirement in the future, and you know how to and what to request, and that's how you manage the policy in the latter years. How much income can you take? How long can you take it? Because when you look at those, even though they're dynamic, you're going to know when you can retire and how much money you can enjoy or not. All right, very, very powerful, very important. And two, now I just discovered this today. Well, let me see. I slipped a question here. What has it been like? What has it been like to share what you've learned with your wife and your children? Do they understand it? Yeah, that's a great question.
So I've been blessed with a brilliant wife and brilliant kids, and my wife understands this concept. I've explained it to her as best as I could, and she understands what we're doing, and she's on board. And you need to have that. It's a partnership.
No question.
And she's completely on board. And my kids our older two children also understand it. Now, they're not fully into it. They just know, they understand it's there. They understand what it is. They understand a little bit how it works. Our oldest child, he actually used that loan feature. He took out a loan, made a purchase, repaid the loan back. He saw how easy it was to access the money, like at the age of 19.
That's awesome.
And so he knows that he's got an asset there. He's got his own little bank. And hopefully it'll be a big bank later. But he's got his own little bank that's very functional. And it was pretty exciting to actually see it in action. I mean, you read about it in a little paperback book. It makes sense and it's logical. To actually do it is amazing.
Wait, he didn't have to know what his credit score was. The life insurance company didn't ask him what his credit score was. And they didn't ask you to co-sign for that loan. You didn't have to. That is awesome. That's very powerful. And then two, listen, I just learned this today. I didn't know this about you. Share with us a little bit about if somebody said, hey, Ori's a pretty cool guy. I want to learn more about him. You're pretty active in some areas that I was completely unaware of until about 10 minutes ago. So educate us.
I'm a big proponent of free market medicine, and healthcare is an aspect of our economy in the United States that is hardly a free market enterprise. It is the healthcare economy is very controlled. The federal government is the largest purchaser. Government in the whole is the largest purchaser of healthcare in the United States of America. So we really have socialized medicine.
Mm-hmm.
And I have been very active and a member of the board of the Docs for Patient Care Foundation, the number 4, pcfoundation.org. And this is a healthcare think tank run by practicing physicians who can articulate the politics, policy, business, and the delivery of healthcare. And it's a very unique group and has very unique expertise. And we advocate for free market medicine because it's better, foremost, it's better for the patients. And it saves them money and makes healthcare affordable. Healthcare is not expensive. Healthcare in the distorted American healthcare economy is expensive. Health insurance is expensive. It doesn't need to be expensive. And because we insure, which means we pay for services we don't use. And that adds to the cost. And so we know that free market prescriptions are cheap.
Mm-hmm.
And they're not expensive. And I'll give you an example, a real life example. So, and this is a nonpartisan issue because we all have and need health care. And notice I'm not using the word insurance, I'm using health care.
Yeah.
And government and politics from both sides of the aisle have equated health care with health insurance. And that really distorts the argument and distorts the discussion. And to the detriment of, first and most importantly, the patients, and secondly, the doctors. And and the example is one where a Republican Congress with a Republican president passed Part D of Medicare, mm-hmm. Medicare drug benefit, with the excellent intent of helping American seniors. And here's an example of what happens when government gets in the way of the free market. So prior to Part D, I had patients who were seniors who did not have a drug benefit, or some that did have a drug benefit, but would like the best deal. And so, for example, I'm a urologist, so some of my patients are on alpha blocker medications, and one of them was called Cardura. And Cardura went generic, and so it was doxazosin. And I had hundreds, I still have hundreds, maybe thousands of patients on this medication. And so before Part D of Medicare, Walmart was marketing generic medications for a reasonable price. And they had a list. And it was called the $4 list. And they had several hundred medications that were generic that were on the $4 list. And it was $4 a month or $10 for 3 months. Okay? Now, Walmart doesn't do anything unless they make money doing it.
Mm-hmm.
At least in their stores. And so they were happy to give my patients Cardura. The patients would walk in there. The patient would tell them, do not run the insurance. Just give it to me cash. And they'd plop down $10 bill and take away 3 months worth of medicine. All right? Walgreens saw this and decided we're losing market share. And they did the same thing. They had their own $4 list and $10 for 3 months. And it was the same medicines on the same list because basically the generic medications. Because how much do pills cost? Right? There's a cost.
For sure.
So when I was a resident, and when we looked at cultures where people had infections, for example, at the VA computer system at the time, when it listed which antibiotics would be appropriate for an infection, would list in another column the price per pill, which is the price the VA was paying per pill. And some of those pills were $10 a pill, and some of them were 2 cents a pill. So if it's a generic medication, it's produced for millions of people, you can pretty much bet that it's pennies a pill.
Sure.
Single pennies a pill. So obviously, if Walmart is selling 90 pills for 3 months supply for $10, and those 90 pills are costing 3-4 cents a pill, okay, if you do the math, they're still making money. Mm-hmm. They're making $8 on a $10 prescription. That's not a bad profit margin. That's 80%. The patient, however, thinks they're getting a good deal, because they are. So in comes Part D Medicare. Suddenly, everybody has drug coverage, right? Okay. So now the $4 list went away. It vanished overnight. Mm-hmm. It vanished from Walmart, and it vanished for Walgreens. Because all those seniors that needed help with their prescriptions, they just got help. The government helped them. Okay. Fast forward to a few months ago. I have a patient who's a veteran. He served our country, deserves to have his drug benefits covered. So he asked me for a prescription for this same medication, Cardura, the generic for Cardura. And I asked him, why do you need this prescription? You already have a prescription on file at the local pharmacy. He says, so I can take it to the VA. I said, why do you need to take it to the VA? You already have drug benefits. You have the Part D. The Part D covers this. It's a cheap generic medication. I mean, it was on the $4 list. So he said, no. It doesn't cost me $4. It cost me $30. I said, wait. You're paying $30 for this 3-month prescription? He goes, yes, but at the VA, they don't charge me anything for this. And I said, they shouldn't. You served your country. And so I gave him a prescription. But then I started thinking. So before Part D of Medicare in the early 2000s, Walmart was making $10 for a 3-month supply of this medication. Now the patient share is $30 for this 3-month prescription. But wait a minute. I pay my taxes, and you pay your taxes. And those taxes are funding Medicare. And Medicare is funding Part D. And the patient's paying premium for Part D. And I'm sure that the insurance is paying something too. Mm-hmm. Let's say they just paid 50% benefit. That means that 90-day prescription, the pharmacy's probably collecting $30 from the taxpayers, $30 for the patient, and a prescription they were happy to sell for $10 and making probably 80% profit.
Margin, yeah.
So they're making 80% margin at $10. The margin now is ridiculous. The taxpayer is paying $30 for a $10 prescription. The patient's paying $30. We didn't help our seniors. Mm-mm. We boxed them into a system where the free market is not available to them. Mm-hmm. And they're paying in partnership with the taxpayers. That individual is paying $30 plus $30 is $60 for a $10 prescription. The system is very broken. And what's broken about it is that it's not a free market economy.
A government intervention.
Correct. With excellent intention.
Mm-hmm.
And that's all I have to say about how free market medicine
oh my goodness
fixes the problem of making healthcare affordable.
And now they want Medicare for all.
Correct. That means everything will be more expensive.
Oh my goodness. Well, I was completely unaware of your activities, and no wonder we connected from just the way you think. I had no idea that you were active in the free market in medicine. I mean, that's awesome. I like the way you think, sir. And I'm going to check this out myself. I'm going to go in there. And so do you do podcasts, radio shows?
Our foundation puts on a radio show every Thursday. And Hal Schurz and Mike Karuchek put these podcasts together, and they have all kinds of guests from all aspects of the delivery of healthcare, and real experts on the free market medicine, from direct primary care, which is a membership model, which doesn't bend the cost curve down for primary care. It destroys the cost curve.
Ooh.
And the president of our foundation, Dr. Lee Gross from Florida, he is one of these direct primary care doctors. And his lecture, you see his basic lecture on direct primary care, and you look at it, and all you can do is just stop yourself from pulling your hair out, because you're like, what? We can basically provide primary care for everybody in the country for pennies on the dollar for what we're paying now. Mm-hmm. What the patient is paying, what the government's paying, what the insurer is paying, not the insurer, the purchaser of the insurance, which is usually either the government or the employer, but even the individual. I mean, it's what we do with, there's podcasts there about cash surgery, where sometimes it's cheaper to have a surgery done for cash as opposed to use your insurance.
Mm-hmm.
So you have to have the right type of avenues of delivery available, because free market creates competition. And what that does is it drives price down and quality up. And the two main examples that you use this to demonstrate this process are plastic surgery. Is if you look at plastic surgery over the years, the cost of plastic surgery has progressively decreased, and the quality of plastic surgery overall has increased. And the ultimate example is LASIK surgery. Mm-hmm. If you look at LASIK surgery, when it was coming out, it was over $1,000 an eye. And now it's way below that, yet every year there's a newer laser, better technology, etc., at a lower price. And so that's an area where there's no insurance and no government intervention into the economy of those two subsections of health care.
No third-party payer.
There is no third-party payer. And what you get is better pricing, better quality.
It's free market.
That's the free market. And so who's going to protect the patients? Well, the government will. There's still regulation. Right. There's still oversight.
Sure.
There's still the job of the physician is still to protect the patient. First, do no harm, which needs to continue being an oath at the graduation of medical schools. First, do no harm, but part of that Hippocratic oath also needs to include first, do no financial harm. So that is an important aspect of the Hippocratic oath that we need to remember. So when we prescribe medications, we need to make sure our patients can actually afford it, mm-hmm. or that they're going to take that medicine, not have to skip eating or paying rent in order to afford that medicine, or have to put it on their credit card and finance it. So it's our job to try to get health care to the patient affordably. But I think there are so many forces and so many 800-pound gorillas in the healthcare policy rooms that forget that it's all about the patient, and that the patient gets their care from the doctor. And if you just remove all these gorillas away and just leave the patient and the doctor, the patient does better and the doctor does better. But the important thing is the patient does better.
Somebody's going to get healed, and somebody's going to get paid, and it's a fair and equitable exchange.
Absolutely.
The free market. I love that. Well, I didn't know that about you, Ori, and I'm excited to even hear that. It makes sense to me why we connected so well, because, we think very similarly. So, do you have any additions you want to add?
I'm sure I'll think about it later.
Right. Well,
probably
we can
at 2 a.m.
Listen, we could do another podcast on free market medicine. Seriously. Okay. Thank you
Absolutely.
for tuning in, and I can't wait to see you next time. Y'all check out the work that Ori Hampel has done with Docs for Patient Care Foundation. Docs for Patient Care Foundation. I just discovered this just like you. I didn't hear about it, so I can't wait to go check it out. Thank you very much, Ori. I appreciate you making time to stop by.
Thank you.
You're welcome.